So what a difference a year makes. Are you looking at these picks, any of them, as better buys now than a year ago? Or do you still look at this with a little bit of concern because of how much the investing picture has changed since then? You hear about new concerns brought against especially these big majors just about every day.
Yeah, so I mean, kind of take those in order. I mean, obviously, hindsight is 2020. You can decide when you should have bought the oils. The question of is it still a good idea today? We would say yes, because valuations are still pretty attractive by any historical metric. The outlook for a full recovery of demand from back to pre-COVID levels is still intact. We would argue that prices are maybe a little ahead of themselves right at the moment, but we still think oil in sort of a 55 to 65 range is what makes sense long term. And that certainly supports, as I go back to originally the valuation side of it.
What about the idea that shareholders themselves are telling companies that they want them to invest in new and different things, that these are basically going to look like very different companies 5-10 years from now? Is that a good thing or a bad thing in terms of whether you should buy in at this point?
No, fair enough. Fair enough question. I would actually say that you're not necessarily seeing shareholders ask for the companies to be completely different. If you look specifically at the three members that wanted Exxon, one is a former oil industry person. One comes out of what was a refinery, but transitioning into a renewable fuels facility, a company, but not necessarily what I would call a quote, wind or solar company when people think green. And the third one is a guy that's, got experience both at the corporate level and at the government level, and probably would be a nice bridge between the two areas that Exxon has typically had a real arm's length, at best sort of relationship with. So I don't look at that as transformative as some of the media headlines have made it. I think it matters because it shows Exxon has failed to generate real returns, but it does not, necessarily translate directly into Exxon's a different company in 5 or 10 years.
Your favorite picks are Hess, Royal Dutch Shell, and Valero. Why don't you explain why?
Sure, I'll go through that real quick for you. So Shell, again, getting back to the valuation question, another big deal. Company did cut their dividend last June, but last April, the payment in June. But the big deal there was $10 billion of additional cash flow that had been going to shareholders was suddenly available inside the company to reduce debt by that incremental amount. With recovery in oil prices, you're seeing Shell do really good things to reduce debt that goes back to the BG acquisition they did in 2016. So this had been hanging over them for a while. So delevering is a large part of the story of Shell. You also have the energy transition. You also have a tremendous footprint in natural gas globally. Hess is one of our other top picks, has been for several years, has performed very well in the space. We expect it to continue again because valuation is attractive here. The story on Hess is the development in Guyana, which is down in South America and the offshore there. We haven't seen anything as good as Guyana, I would almost say, in my experience working in this business for over 20 years. It's one of the best opportunities, overall discoveries of production costs, of development costs. Exxon is the operator there. And then Valero and refining, we really like the overall setup coming out of the COVID issues, the resurgence in driving, in air travel that's coming. And Valero is the purest of the large cap refiners. And so that gives you the best leverage to that opportunity. Also,
Roger,
the oil markets.
The consumers coming back, people driving, summer, all these things, near term. The little engine that might get its third seat. When do these things really have already they're having an effect on capital raising and on shareholder involvement with these companies. But I wonder when it actually does. Is it 10 years? Is it 15 years? And I know you've seen what some of the blue states are doing in terms of powering the grid and actually trying to not use natural gas. What should it be nuclear? What should be powering it? Can't be coal. It can't be solar and wind exclusively right now. So what do we do for the next 5 years or 10 years?
Well, I mean, I think that's part of it. We've written about this fairly extensively over the last several months. But what you're really looking at is you're going from an energy density situation with oil, gas, and coal, call it fossil fuels. Uranium you could fit in there as well. And then if you look at a lot of the energy transition, it's energy diffuse, but it's materials dense. And I think one of the things people should consider is getting a lot of materials in place and constructing all the things that need to be constructed merely to meet growth, much less replace everything that's already there, is simply going to take a lot more dollars and a lot more time than 5 to 10 years. There's also the parts that, are just very difficult to abate, as they say in the business. And some of that's going to not really ever change potentially. And I think you should consider that oil and gas is a substantial portion of transportation, but it's also how you make plastics, right? And so much of this new stuff is plastic or is using plastic. And you're actually going to get from plastics and from mining a big boost in oil demand for the next several years. I can't speak to all the above ground political issues in terms of if the city bans the use of gas. They may not do that, and it will have some impacts on growth. But you're, again, impacting growth, not necessarily the base level of demand. And that, again, it just takes a long time.
Roger, thanks so much for your time this morning. It's good talking to you.
Shepard Smith here. Thanks for watching CNBC on YouTube.